Hey rich girls, Kirby here, and I have a feeling that with all of the current news cycles and recession talks, you might be feeling a bit overwhelmed when it comes to personal finance and investing right now. We all know how draining and stressful the doom scrolling can be, but today we are going to break that cycle by talking about the 4 things you can do to override that sense of impending doom and kickstart your investing journey with a little pep in your step. Welcome to Rich Girl's Guide. I'm Kirby, a former wealth management 9-to-5er, and today's episode is for anyone who wants to start investing but hasn't yet pulled the trigger, or you have already started your investment journey, but maybe the current news cycles are making you nervous. First and foremost, be sure to stay the course. If you already have an investment plan, this is the time to stick to it. You should not be making any rash decisions about your money just because Joe Schmo with the podcast said the world is collapsing, and you should sell all of your stock. In fact, it's uncertain times like these that are the absolute worst time to sell out of the market. If anything, when the market tanks, you want to be buying mutual funds and stocks when they are quote unquote on sale. But I'm getting a bit ahead of myself here. The most important thing is to keep your head down, keep investing, and keep following your plan of action. My biggest tip here is to be super mindful of who you are following online and who in your life you are taking advice from. If you notice that there are certain political commentators or money gurus who are constantly popping up on your feed, and every time you watch a clip you get anxious or feel bad, it might be time to get familiar with that block button. The same thing goes in real life. If Uncle Jerry is constantly texting the group chat with doomsday articles or chatting you up at every family function to make sure your bunker is fully stocked, and you find yourself getting antsy about it, don't be afraid to cut a bitch off. Okay, maybe not completely cut them off, but you know what I mean. Steer clear of the things or the people that are causing you to second guess your personal investment choices, when those people or articles have no effing idea who you are or what your long-term goals may be. Moving on to tip number 2. What if you had a plan of action that was quite aggressive and you want to scale it back? Changing your investment plan, after careful thought and consideration, of course, is perfectly fine in times of economic uncertainty, especially if it gives you peace of mind and ensures you can actually go to sleep at night. If you are invested in the market and need some ideas, definitely check out my previous episode, How to Recession-Proof Your Accounts. By the way, all of the episodes I'm mentioning today will be linked in the description and show notes. My previous point about staying the course is specifically targeted towards those who get spooked and want to sell a significant portion of their portfolio and hold on to cash to quote unquote stop the losses before it's too late. That is a rash, fear-based decision that will bite you in the ass 99% of the time. Changing your plan, on the other hand, could be something as simple as slightly decreasing your equity exposure, aka your riskier assets like individual stocks, and slightly increasing your fixed income exposure, which is typically your less risky assets such as bonds or treasuries. Now, I'm not going to get into the nitty-gritty of what a balanced portfolio looks like, so if you want more insight as to how you can craft a portfolio that aligns with your specific risk tolerance, I would highly suggest watching my episode, What to Hold in Your 401k. This episode has a ton of great information on how to choose between different mutual funds, what an ETF is, and all of that fun stuff. So just to recap, tip number 2 is to carefully consider any changes you want to make before you pull the trigger. And be sure to give yourself some buffer time before you actually implement any changes, say a few days or even a few weeks. In the grand scheme of things, if you are looking to be invested in the market for, let's say, 5, 10, 20, 40 years, waiting a few weeks to make any changes is just a tiny little blip in the radar. I would much rather you wait longer and be super secure with your decision to make any changes and even possibly lose out on some market gains in those few weeks rather than pull the trigger too early and possibly have regrets about it later down the line. Now, what if you are brand spanking new to investing, but you are now nervous to dip your toe in the water? Welcome, my friend. This is the world of investing. Constant speculation about future economic trends that no expert or mind reader, for that matter, could possibly predict. The good news here is that the best time to invest is today. Every day you wait to start your investing journey, the less compound growth you are going to receive. Like I said earlier, if you are investing for the long term, which, let's be real, we all need to be if we want to retire before the age of like 85, then investing now versus waiting until the opportune time when the market bottoms out or whatever really does not matter in the long run. What does matter is whether or not you actually start investing. The longer you put it off, my friend, the less money you will have in the long run, regardless of how the market is performing. I actually have a step-by-step guide for investing newbies like you, how to invest your first 1K. So I would highly recommend checking out that episode if you need some encouragement, and especially if you need information on how to actually start investing. Okay, last but not least, and this is hands down my favorite tip, is to start tracking your overall net worth on a quarterly basis. This is particularly helpful if the market is all over the place or recession talks are swirling about. Yes, your investment accounts and retirement funds are important, but they do not make up your entire net worth. Most of us have things like property, whether that's a house or a car. We have debt that we are paying down month over month. We hopefully have some emergency fund savings or other cash savings that are separate from our investments, but are very much still considered assets. I have personally found that consolidating all of our assets into a nice little spreadsheet and tracking them quarterly greatly reduces my stress in times when the market is underperforming. By seeing progress on paying off our car loan, paying down our mortgage, while also increasing our savings, I am lessening the blow of seeing a decrease in our investment account balances, because that's going to happen. If you want to take it a step further, you could also build out a future value calculator and see if you are still on track to retire with your desired dollar amount based on today's market value of your accounts. For me, that is an oddly comforting tool. It's nice to see. So I will drop yet another episode, how much money do you need to retire? And that will actually walk you through the process step by step to build out that calculator in Excel, if you're a little extra like myself. At the end of the day, your investment journey is up to you. Even if you hire a financial advisor or build out a financial plan with a CFP, you are the one who actually has to follow that plan and live with the investment choices. Be mindful of who and what you allow to influence your investment choices, stick to your plan, and make adjustments when needed after thought and consideration. And make sure you are looking at the full financial picture before stressing yourself out too much. And if none of that is helping, put your phone down, take out your earbuds, and go for a long walk. There has never been a problem or stressor that I made worse by taking a long walk and clearing my head. All right, guys, thank you so much for listening to today's episode. If there are any specific topics you want me to discuss on an upcoming episode, please drop a comment below. Be sure to subscribe on YouTube so you don't miss any upcoming episodes, and I will see you next week for our third installment of the Rich Girls Guide Book Club. Later.